There's a retirement account move that lets a self-employed business owner shelter over $275,000 a year completely legally, and your financial advisor will never tell you it exists. Not $23,000, not even $69,000, $200 and $75,000, wiped off your taxable income every single year. And if you're over 50 when you start, the number gets even larger. Most people grinding through their 40s and 50s are maxing out a 401k and thinking they're doing everything right. And they are, for employees. But that $23,000 contribution cap was designed for someone clocking in for somebody else. Not for consultants, not for doctors, not for attorneys, not for anyone running their own operation. The tax code has a completely different set of rules for you. Rules that can legally eliminate 6 figures of taxable income every single year. But they don't teach this in school. They don't explain it at the bank. And your advisor, they probably make more money selling you mutual funds than they ever would setting this up. It's called a defined benefit plan, not a 401k, not a SEP IRA, a defined benefit plan, and the name is the key to understanding exactly how it works. With a standard 401k, your contribution is defined. You put in $23,000, you get $23,000 in the account. Simple. With a defined benefit plan, the logic flips entirely. You define what you want your retirement benefit to be, a specific monthly income at age 65, for example. Then an actuary, a government-certified number cruncher, works backwards and calculates precisely how much you need to contribute every year to hit that target. And here's where it gets interesting. That required annual contribution, it's 100% tax deductible. Every dollar drops straight off your business income before the IRS ever sees it. Let's run the actual math. Say you're a 52-year-old consultant earning $400,000 a year. You open a defined benefit plan. You declare that at retirement you want the maximum annual benefit the IRS allows, which in 2024 is $275,000 a year. The actuary calculates. You have roughly 13 years to fund that benefit. Required annual contribution lands somewhere between $200,000 and $275,000. Every dollar of that comes off your taxable income. At a 37% federal rate, that's over $100,000 in taxes you don't pay. This year, next year, the year after that. Now compare that to your 401k. You'd max it at $30,500 with the catch-up contribution. That saves you maybe $11,000 in taxes. The defined benefit plan saves you 10 times that. And here's the part that sounds backwards but is completely real. The older you are when you start, the higher your required contribution. Because you have fewer years left to fund the promised benefit, each year's deposit must be larger. A 58-year-old can sometimes contribute more annually than a 45-year-old. Time pressure becomes a tax advantage. The IRS built urgency into the math, and it works in your favor. This is the retirement vehicle of high-income doctors, attorneys, solo consultants, and business owners who already know how the game is played. It isn't buried in obscure fine print. It's sitting in the IRS tax code right now, open to anyone who qualifies. But setting it up requires an actuary and a third-party administrator. It takes about 6 weeks to establish. It costs a few $1,000s a year to maintain. And that right there is why your advisor never brought it up. A mutual fund sale is clean, fast, and commission-bearing. The work involved in establishing a defined benefit plan earns them nothing up front. They're not lying to you. They're just not volunteering information that doesn't benefit them. Now, this isn't for everyone. The IRS requires you to fund the plan every year. That part is mandatory, not optional. If your income fluctuates, you're still obligated to make a contribution. You need real business income and an actuary who validates the numbers annually. But here's the reframe. The IRS didn't build this into the code by accident. They created it deliberately to encourage retirement savings for the self-employed. They want you to use it. The mechanism is legal, it's documented, and it's been used quietly by high earners for decades. The only question worth asking is why nobody put it in front of you until now. If you're self-employed and clearing more than $200,000 a year, you are almost certainly leaving six figures on the table every single year, not because the law won't let you keep it, but because nobody told you the law existed. And this is just one piece. There's a companion move that stacks directly on top of this, a way to pull money out of the plan on the back end that the IRS actually rewards you for doing. That's the next file. Because once you learn one rule they never taught you, you start wondering exactly how many more they're still keeping quiet.